we've been making money long or short. It just fascinates me that the one day it's up, everybody brags that they're geniuses. It just cracks me up. But we made money long and short. We shorted gold. We bought Datadog. We did a number of things. And I'm going to go over the ATR trailing stop and how we do this. Basically, we're here just to show the trend. I can't stress enough that you see 99% of people on posts on Twitter from so-called pundits, and they're 99% right, where 95% of traders lose money. So just keep that in the back of your mind, that you're here to do the trend, to buy on the way up, short on the way down. Let me give you a for instance in here. Let me be sure I have Restream working. Yeah. Now, number one, did anybody see my stock twits post from yesterday at the bottom? So I don't just do charts. I try to combine it with fundamental data and logic and savvy from all the years I've been doing this. What am I talking about? Couldn't have timed this better, could I? This is what we did yesterday. That is the price support and Congress support. That's where the Marjorie Taylor Greens of the world and all that, public record, that's where they bought on the 7th and 8th. The markets approached that. Did you really think they would be underwater on their investments? Did you really think that would happen? No. So that was the price support. We called it at the bottom. So you knew there was going to be good news coming out because there's too much pressure from all these people to, for things to go up. So, and that was the bottom. So you also had multiple price support. But I wanted to show you something else because so many get this wrong. So let me show you what we're talking about right here. So you're in a long-term downtrend. So don't, just keep that in mind. That's number one, but that doesn't matter this minute. What matters this minute is it's very news related. So if you go over here on the right, does everybody see where you buy if you're using the ATR trailing stop? If you're going to short-term trade, not long-term, but short-term, whether it's a 5-minute, a 15, an hourly, you better be on the correct side of the trend. So about Besant, it's on, go to stock twits. I mean, trade it, Thinkorswim, and just put in SPX, SPY, and it'll show you in there. It'll show you the news. Go to live news, all 11 channels. Besant signals willingness to offer thingies. They're all in here. De-escalation. Did you think that wouldn't come out if all the Congress people were going to be underwater on their investments? Besant, what did he do? He was a hedge fund manager. So don't forget that. But getting back to it in here, how do you play the ES? Well, and I know that so many sites, what they do in here is they're buying on the way down. So I'll show you where you buy. Does everybody see that in a downtrend, if you're going to buy, you better buy when it gets over the ATR trailing stop. Bull flags over the ATR trailing stop are more likely to work. After protracted up move, the first sell-off usually results in a temporary oversold. When I use the ATR trailing stop, the 9 and 2.9. So like I said, there's a lot of imitators, but there aren't a lot that have been using it for 30 years. Got to combine it with the MACD. The key is how it works off any oversold. When it rallied here, how did it work off that overbought? Oversold or overbought? It worked it off by retaining a bullish structure, by going to zero and retaining a bull flag. There's your bull flag. This, it got overbought. This is a diamond formation or an head and shoulders consolidation. Head and shoulders consolidation can go both ways. But the point is that if you go, let's say you're playing like an algorithm. So all you're doing in here is you're selling when it gets under that ATR trailing stop and buying when it gets over, or vice versa. You're going to see that when you're wrong, you're just not going to lose a lot. So if you bought right here, well, I wouldn't be buying in a downtrend, but if you did, you can't buy in the downtrend because you're going to lose fast. If you buy up here, you sell there. If you buy here, yeah, you sold here, you lost a little. If you shorted here, you made a lot. If you bought here, you're out here, or you get back in here. The point is you're doing it like an algorithm. I mean, that's how the algorithms are doing it. So, just you got to understand that most algorithms are incredibly simple. They're not 100 different indicators. They're using the moving averages and all this stuff. That's all they're doing. Usually, though, and this is something that's really important with the ATR trailing stop. Number one, I'm just using who invented it, and I'm using a 9 and 2.9. Like I said, I've been using it 30 years. There are a lot of imitators. This is what's worked for 30 years. Number two, you have to have the MACD. I'm using the 3, 10, and 16. So if you have Thinkorswim, using exactly the same thing. I'm using the 9 and the 2.9. You can have simple exponential. I'm just telling you they're close enough. And I'm using a 3, 10, 16 simple. That's it. That's all I'm using. So you identify the downtrend. Darn right, it's in a downtrend on a daily. But that doesn't mean you can't make money on the upside. I see more people saying, oh, you're in a bear market, we can't ever buy again. No, some of the best money I've made is on the long side in bear markets, because the bear market rallies are so vicious, like today. Look how long it took for the markets to go down in here. Look how fast they went up. Yeah, this took a day. This took 15 minutes. So I'm just telling you, you can make a lot of money in bear markets. So what are you noticing in here? Well, there are a number of things. Number one, when I try to determine a swing trade, I have to look at the long-term trend. So a break above the ATR trailing stop on an hourly on the upside is it's going to work, but you got to look at all the resistance zones. You're in a resistance zone. In a bear market rally, a lot of times it overshoots because you get a short squeeze. But it's now getting overbought. But overall, long-term downtrend. Hourly, yeah, turn the corner. But you got to combine it with the MACD. So what happened? You got over the ATR trailing stop. The MACD got back to zero, and it stayed in a bullish structure. Overbought, stayed in a bullish structure. Real overbought at resistance. I'm not going near it here. We're out. So we did probably about 6 trades in the last 2 days. I think we're like 4 out of 6, 5 out of 6. The big one was First Solar that paid for any mistakes. Yeah, we came in long. So we came in long First Solar. Now, the problem with these is that over the ATR trailing stop, a lot of these are still in big old downtrends. So you got to take your profit. Like this, had to take your profit. In here, we saw a tight pattern. Tight pattern. If you're going to play on the long side, you need to add that. So that's the way I look at it. And so I have to tell you right now, you're going to have somebody banned for promoting their site. So just to let you know. So I don't expected move. I traded on the CBOE for 8 years. I don't even use the expected move. That's just where it is now. How on earth can you take an expected move when the expected move, like today, has been a lot more than what it was predicted? I don't even use the expected move. I use the expected move with chart patterns. So if I see a bull flag, and there's no resistance for the next 60 points, then that's what I'm looking for. I don't even use the expected move. So I don't see where that helps. Look at this over here, and this was posted before the opening. Go and look at the SPX. There you go. Expected move is the previous move up. That's called a measuring gap. So it gapped up here, never filled it. Previous move was 64. The move was 64. My expectation was to fill the gap. That's it. I mean, you don't have to make it more complicated than it is. I can't tell you. Yesterday, was the expected move in the SPX 170? No, it was 40, and it moved 170. So I have no idea how expected move helps with anything. So sorry if I sound adamant, but I'm seeing that from so many people that never traded on an option floor. So I'm just telling you, measured move, resistance, the path of least resistance. There's no resistance in here, and that's where it went. So pretty cool. Now, are there other ones? Well, number one, like I said, I wouldn't even look at expected move. Number two, it's not a average true range. It's the average true range trailing stop. All I'm doing is taking a multiplier of the average true range, and I'm using it to determine the trend. You can see it in here. Look how well it worked in here. Even here, if you shorted here, you're buying here. Yeah, you got stopped out. Then you buy here, you get out here. That's a lot. That's 200 points. So the key is to determine the chart pattern and determine, like I said, the average true range. I'm using it as a trailing stop. So now and it got up to my objective. That's it. So then it's risk reward. So if you're playing on the upside and you see it get to your objective, which it did, see the gap, then what you're doing, if you want to stay in, you better go to a shorter term pattern to time your exit. So when I see it do everything I thought it would do, then you better go to a shorter term chart to time your exit, probably a 2-minute. See on how it got under the ATR trailing stop? One thing a lot of people get wrong, they think automatically you sell here, you short here. No. After a protracted up move, the first move in the opposite direction is usually a fake out because it gets too oversold. It's the second move that matters. The other thing is, if you want to do it like an algorithm, buy here, sell here, buy here, that's fine. But we like to combine it with chart patterns. So if we see something under the ATR trailing stop and a topping formation, yeah, that's real powerful. So real powerful. So I'll show you like Amazon. This on a 1-minute chart. Where do you buy Amazon? You buy it in here. Where do you get out? You get out right here. So, I mean, you see it, and you see a little bear flag after the break. So a lot of times we don't even trade it on the short side on the break. We short it after the first consolidation. So I just can't stress that enough. So if you want to just do it like that, that's fine. But the bearish patterns are more likely to work when it breaks the ATR trailing stop. Bullish patterns, the opposite. But you also have to respect that we don't just blindly use this. We combine watching gold, watching the transports, watching the Russell, watching all of these. And you'll see, if you see this going up and the thing that made it go up, well, you see it right here. Red means that it crossed the ATR trailing stop to the downside, that it's under it. So, and you see it. So they're all red. The reason I have a lot of stocks up is a lot of times they'll look bad before this breaks. It's a good way to anticipate. So you'll see in here that like Amazon broke before the NASDAQ did. Meta broke before the NASDAQ did. Now, if these sold off and these all were still green and over things, Yeah, I wouldn't even think of shorting the markets. In fact, right now, I'm not sure what I'm going to do. We totally are flat in our chart patterns mastery. In fact, we lost $10, $15 in the SPY, but we made 20 to 50% in a number of things. So we're out. We'll reevaluate. So the thing is, and let's go over it. First things first, the ES on a daily chart, overbought in a downtrend. What's that mean to me? It means that if you reach your objective, like you see, or like you see over here, when you reach that objective, you're looking, because you're in a long-term downtrend, you're looking for the short entry. You could make the buy entry up here, but now it's overbought and it's in a longer term downtrend. Usually the way I do it, if I'm going to do an hourly swing trade, I better have the daily in the same direction. If I want to do a 15-minute, I better have the hourly in the same direction. A 5-minute, I better have the 15-minute in the same direction. Once this reached the objective, almost exactly. So if you're wondering what this is, these little arrows, that's a measuring implication. So yesterday you rallied on the close. You rallied 64 points. It got up today and never filled the gap. So your measuring objective not only is the prior move, but that also happens to be the gap. So that was a beautiful objective. Beautiful, beautiful objective. So keep that in mind in there. So that was a beautiful objective. So not only were you going on this measuring, now you might say, yeah, but if it's here, how do you know it's not going to fill the gap? That's a great question, because it never violated anything. It just kept going. So once it kept going up here, you knew it was probably going to go to here. So, and we got out of everything. So we're now the SPY. Yeah, we could have stayed in the hedge in there, but we got out of gold. We got out of Datadog. We got out of IONQ. We got out of everything. We would have even made an SPY, believe it or not. So pretty cool. But getting back to it, if you get to the resistance, so don't make it harder than it has to be. What do I mean by that? If it gets up to the resistance and it's overbought on a MACD, you're looking for the bearish reversal candle. So if I put the hourly over here and I erase all these drawings, you can see it easier now, that resistance area. It's an area. It's not an exact price. It's not an exact price. When you see it overbought at resistance, you're then looking for the reversal pattern. You're looking for the reversal pattern. So in here, no, I don't think, I've showed this graphic a million times here. This is what I think. I think you're in a long-term bear market. I think it takes months to work off the damage. So no, I do not think we're at a bottom. I think we're at a temporary bottom, no doubt. But I'm telling you, when you see the hourly, because we're talking about the ATR trailing stop now, not broad market stuff. When I see this and it gets to the resistance, if you want a short, you got to see that. Look at that. That's a head and shoulders top. I think everybody knows that. The point is, you didn't have one all the way up. You had one here, but like I warned you, that resulted in an oversold condition. Don't trust the first break under the ATR trailing stop. So that's what I wanted to show you. So longer term, just go on this. Take that graphic I just showed you. So take that graphic right here. That's your sentiment cycle. On the right, I'm going to show you a daily chart of the SPX. Oh, let me show you. So we're going to take a daily chart of the SPX. And you tell me if this looks familiar. All right. Take this. Then you had the first break. And then the panic. All right. Does this look familiar? I don't know about you, but I think this looks pretty similar. You have this, similar to that. You have the first break, similar to that. And now you have the panic, similar to this. What usually happens after that? Then it takes weeks to work off that panic. So because the sentiment gets too bearish. And then what happens is you futz around for weeks. And then you slowly go down. That's your discouragement phase, where you go down for a long time like this until you can do that and form an inverse head and shoulders. You can find this on 5-minute charts. You can find it on daily and weekly. But you'll see another thing. Number one, on a weekly chart, the SPX is under the ATR trailing stop. On the daily chart, it's under the ATR trailing stop. So they're still in downtrends, but it really helps to have the MACD in your favor. So definitely having the MACD in your family, in your favor. GDX is, we were short gold, but I'm telling you right now, you knew gold would go down if the GDX was acting so poorly. So, but it's really lagged. Our only regret is we were going to buy dust this morning, but I have to warn you. Inverse ETFs are not the way to go. I just can't stress enough. They have slippage. For a day trade, sure, dust is fine. But I'm telling you, any of these. So you have the SOX. And then you have the SOSX. These are both inverse ETFs, ultra ETFs. So I just want to show you something if you want a nice eye opener for you. Just take the beginning of 2024. This was 30. This was 60. Add them together, that's 90. Theoretically, you would think if you bought this and bought this, you'd break even. No. You'd be down 50% at least. 30 and 60 is 90. Where are they now? 35. It's slippage. If you're going to play any of these, you have to play them ultra short term because they're designed to go down. So I can't make that more clear. Now, the next thing, and as you see, it's working. That the markets hit their upside objective. Remember that gap? And they have just crapped out from that upside objective. Now, if you want to ride the white pony of the short side on a 2-minute chart or a 1-minute, what's telling you to get out? Nothing. So you shorted on the break and the head and shoulders. So what happens is you break, you get oversold, and it's how you work off the oversold. It worked it off by retaining a bearish structure. See that? Bearish structure. Got under it, bear flag under the ATR trailing stop. You short on the break. So that's what you did. It's only worth 40 points. Now, how do you get out? Let's say you're short. Well, number one, when the markets go down too fast or up too fast on a 2-minute, what's going to happen is the average true range is going to widen. So it's getting too far from the ATR trailing stop. So now you don't want to use that as your stop because, heck, that's 30 points higher because it went down too fast. So what you want to do is take some moving average that would at least make you disciplined to get yourself out. So you could take a 9, you can take a 20. A lot of times when it goes down that fast, we take something like a 9. So let me go and show you. Just so you have a way of discipline. There's your 9 EMA. This way you can ride it a lot more. For me, number one, I'm not going to be mechanical when it gets that far under the ATR trailing stop. I have to look for where the support is, and you see where it is. When it gets this far from the ATR trailing stop, I usually buy back half. So if I'm short 2 futures, I buy 1 here at support. The other one, I'll probably try to stay in. But I'd probably go to a 1 minute. There. That way you're out here. So you're shorting on the break of the ATR trailing stop on that 2 minute. You're getting out at support on half, and the other you get out here. You don't want to use the ATR trailing stop because it went down too fast. Just like here. It went up too fast. You better use something else. Now, usually we'll use this one. But because this one will stop you out a lot. But at least you stay in longer than you would have other times. If it crossed here, I just don't want to get out there. It's too wide. So, I mean, that's what we're doing. Now, what do? Well, like I said, we're still in a longer-term bear market. Chart Patterns Mastery, good exit in gold. Good exit in IONQ. I'm just telling you that if the markets are going down, the things you liked are going to get pulled down as well. Holy crap, we got out at 92. We're out of that. We're out of IONQ. Gold, we covered here. So here's a perfect example. We shorted here. Does everybody see the bear flag? There's your bear flag. We were short. So it starts going down, 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 down. Where do you get out? Well, there are a couple of ways, but basically we got out when it got too far, sort of like a bloop. So you're hugging the ATR trailing stop and then boom, like a panic sell. Then this is too far from the ATR trailing stop. So we got out here. Believe it or not, we got out here. So if you didn't get out there, then you better get out when it crosses the ATR trailing stop and forms a bull flag. So I'm just telling you, it forms both ways. You had a bull flag here. You had a bear flag here. A bull flag right at the ATR trailing stop, you got to buy when it gets above it. Because bull flags in a downtrend are not to be trusted. But if you want to buy right here, you got to have your stop under the breakout. Here was an easier one. You buy on the break up because you're already in an uptrend. So hope that helps you. So that's what we were doing. So Chart Patterns Mastery, like posted, we're out of everything. Holy cow, how are we out of everything? I'll get in things later again. And this is the problem when you're in a big old downtrend. The problem when you're in a big old downtrend is you're going to find stocks that have bullish patterns. But to me, under the ATR trailing stop means or the 50, mean you're still in a downtrend. So you can take everything else off. There, you're in a downtrend. Now, there are going to be stocks that have bull flags in a downtrend. I would rather buy them on the break that's close to getting above things again. That's a rough one. Is it a bull flag? Yeah. Does it have very little resistance? Yeah. Is it under everything? Yeah. That's the problem. Look at the difference between this bull flag, and we were in it back here, by the way, that broke over the 50, broke over the ATR trailing stop, and it went from 3 to 9. When it gets under the ATR trailing stop, it just doesn't have the same mojo. So I hope that makes sense. That's the problem. There are a lot of stocks that have good charts, But the problem is they're still in downtrends. So they're not that good. I'll show you an example. We're in Datadog. Now, you might say, why are you playing Datadog? It's in a downtrend. Well, it looked like a bull flag. But you can't overstay your welcome because it's a bull flag in a downtrend. So the second the market weakened, look how fast it went down. That's the problem. If you're going to play a stock that looks okay in a downtrend, you can't overstay your welcome. You got to go to a short-term chart to time your exit. So we saw this bull flag. We also saw the measuring on how much it went up yesterday. So it got above that. We stayed in it. We got in actually right there on that break up. Right there. That's where we got in. Did I get out here? No. I was away from the desk, thank goodness. We got out up here. So the point is there are a number of stocks trying to bottom, but they're still in downtrends. So, I mean, that's how we're looking at it. So the ATR trailing stop really does help. Now, GDX, it's a good point about it looking weak. Totally understand. But here's another one. It got too far from the ATR trailing stop on the upside. So it'll probably futz around like it did here, 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 and here until the ATR trailing stop catches up. Just gets too darn far away from it and too far from the 50. That's the way I look at it. So I hope that helps. Thanks for listening. And I'll be back in the Chart Patterns Mastery Room. And if you don't follow me on StockTwits, it's free. But most of these posts have been pretty good. There's First Solar, we came in long. So, and I'll show you real quick. Here's a cycle chart. Now, you might be like, why the heck are you showing a cycle chart? It's not just blindly cycles. There's somebody, Arch Crawford, does planetary cycles. What this means, and this is a good trader trick, companies voluntarily don't buy back stock 5 weeks prior to earnings. When do the earnings season end for most of the S&P? The end of October. So the middle of April. Yep. Beginning of August. Isn't that amazing? And that coincides with the cycles. Now, the reason I'm showing you that is the ATR trailing stops are more likely to work on the downside when companies can't buy back stock. So just keep that in the back of your mind. And it's worked with Apple. It's worked with them all. So take care. Have a good one.